Thank you for joining us for this quarter's Observations in Global Equities and Fixed Income. My name is Adam Sparkman, and I'm a client portfolio manager with Thornburg Investment Management. Today I'm joined by our co-heads of investment, Ben Kirby and Jeff Klingelhofer. Gentlemen, thanks so much for joining us. Ben, both in the US and Europe, core inflation has been persistent and remains stubbornly above that 2% target that central banks have set. Do you think that we may be in a higher for longer interest rate environment? And if so, what do you think the potential implications are for equities?
I think a base case is that rates need to be higher in the next 10 years than they were in the last 10 years. And that's going to be driven by higher inflation, but also realization that zero interest rates was maybe a bad idea in the first place. What that means for equities is that the discount rate you need to use as you think about discounting your equity valuation is going to be a higher rate, which inversely means a lower equity valuation. So, I think about comparing equity valuations on an equity risk premium basis to fixed income on an inflation-adjusted basis. So think about TIPS, which are going to give you a real rate of return of about 2% today with a 10-year duration. That's actually really attractive. Compare that to the S&P 500 at an 18.5 PE. If you want to invert that, that's about a 5.5% equity risk premium. Subtracting out the 2%, you're at 3.5%, which is historically relatively low. Which to me argues that bonds look a bit more attractive than stocks today, at least at the headline level. There's a lot of places under the headline that you can find some really interesting equity valuations today. But at the index level, bonds look pretty attractive.
Jeff, so we have money market funds, treasury bills, and CDs yields surging as the Fed has tightened rates through the cycle. Is it prudent for investors to park their funds into these vehicles, or do you think that fixed income perhaps offers a better alternative?
I think the answer to that question comes down to what are you trying to accomplish? I think the reason why most investors are moving into money market funds is because they're scared. Right? It's a way to, quote, hang out and just wait to see what happens. I would say just recently what we've seen is money market funds have actually stayed, the front end of the yield curve has stayed relatively constant. We've seen the back end of the yield curve actually come up quite a bit. So we've seen a little bit more steepness in the yield curve, a little bit closer to traditional and normal. I think regardless, we've seen such a tremendous rise in the broad level of yields that now is the time to play safety, right? Coming out of a very low period of interest rates, as we've talked about, we don't think that's likely to continue indefinitely, and obviously it's reversed thus far. But what we do think is we're reverting back to a more historically normal environment where if we do see the recession come through, we will see yields fall, and you'll get an outright positive return on very high quality fixed income if you have a little bit longer duration. So we think now is the time to take advantage of that move. We continue to think the sweet spot of duration is somewhere between 3-4 years. Because that takes advantage of, one, yes, higher income on the front end of the yield curve. And of course, there is always the right tail risk of continued higher inflation where the Federal Reserve and central banks of the world have to move more aggressively. So we like that 3 to 4 year part of the yield curve in particular, but now is the time investors should be moving.